Imagine this: a fund that pays steady high yields when everyone else is earning crumbs. Loans that are short-term, secured, and safe. And a promise that your money is helping real businesses bridge the gap. Until, suddenly, the bridge collapses. Accounts are frozen. A receiver steps in. And the safe yield turns into a very expensive lesson. This is the bridging finance collapse. How a search for yield became a masterclass in risk. Bridging finance sounds simple. Short-term, higher interest loans to companies that need quick cash to cover payroll, inventory, or acquisitions, until longer-term financing arrives. Investors fund the loans, collect the interest, and, on paper, everyone wins. In reality, it's a complex machine with moving parts, valuations, collateral quality, borrower health, and liquidity. If any of those gears grind, the whole engine seizes. The pitch is seductive, consistent returns, asset-backed, low volatility. But here's what the pitch often forgets to mention: concentration risk, too much exposure to a few borrowers, opacity. Private loans aren't priced on an open market. Liquidity traps. Redemptions can be paused when cash gets tight. Conflicts of interest. Who benefits when deals are made? And how? When yields look unusually smooth, it's worth asking, at what cost? At first, the warning signs are quiet. A delayed audit, a tough borrower that needs just a little more time, an extension here, a modification there. Then come the headlines: regulatory questions, frozen redemptions, investors told to please be patient, and patience doesn't pay the bills. Once a receiver is appointed, the tone changes. Now it's about recoveries, not returns. Loan files are reviewed, collateral is tested, and asset values get a reality check. The language shifts from marketing to math. What's actually collectible? What's impaired? And how much will investors realistically see after fees, costs, and time? Retail investors chasing yield get stuck first. They can't redeem. They can't sell. They watch statements turn into estimates, and estimates turn into write-downs. Borrowers get squeezed too. If funding dries up, projects stall, and without fresh capital, even decent loans can sour. In a collapse, there are almost never clean exits, only trade-offs. Lesson 1. If the yield looks too steady, ask why. In private credit, smooth lines can hide rough seas. Lesson 2. Liquidity is a feature until the moment you need it. Read the fine print on suspensions, gates, and redemption terms. Lesson 3. Independence matters. Independent valuations, independent oversight, independent custody. Trust is not a control. Lesson 4. Concentration kills. One borrower, one sector, one insider relationship. That's not diversification, that's a bet. Lesson 5. In a downturn, models become memories. Only cash recoveries count. Bridging finance promised a faster lane to higher returns. But when the traffic stopped, investors discovered the exits were closed. That's the real cost of opacity. By the time you see the risk, it's already priced in. This is Backdoor Billions. Subscribe for more stories of money, power, and the truths they tried to bury.